EPK Capital presents Daily Brief for 16th August 2025. Hello everyone, welcome to EPK Capital's Daily Brief video. I am your host Kunal. In this series, we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. Part 1. Executive Summary and Market Snapshot. Friday, August 15, 2025, presented a market landscape defined by a profound paradox. While the Dow Jones Industrial Average, a benchmark for America's most established companies, flirted with record highs, the broader market was gripped by a palpable sense of anxiety. This was not a simple risk-on day. It was a day of stark divergence, a narrative split between a powerful company-specific story of value investing and a cascade of macroeconomic fears concerning inflation, trade policy, and a looming global slowdown. The day's trading was ultimately shaped by three pivotal and often conflicting developments. A surprisingly hot inflation report from the United States that rattled the technology sector, a fresh batch of data revealing a sputtering economic engine in China, and a landmark regulatory shift in the US that could fundamentally reshape the future of cryptocurrency and its integration with traditional finance. The performance across global indices tells a story of fragmentation. The tight, positive correlation that often characterizes market movements appeared to break down, replaced by a more selective environment where specific regional and sectoral narratives held sway. The US markets were a microcosm of this division, while Japan showed notable strength and European bourses remained muted amid holiday-thinned trading. Indian markets were closed for a national holiday, but the day was marked by a significant economic policy announcement that set a clear course for the nation's domestic agenda. This divergence signals a mature, perhaps late-cycle market environment where investors are no longer buying assets indiscriminately. Instead, a clear preference emerged for perceived safety and quality, as exemplified by the Dow's resilience, while simultaneously punishing assets most vulnerable to macroeconomic shifts, like the growth-oriented stocks of the Nasdaq. The forces acting on the market were not uniform. A positive, company-specific catalyst was potent enough to insulate the 30-stock Dow from the negative, market-wide pressures that weighed on the broader technology sector. This suggests the era of a rising tide lifts all boats has been put on pause, replaced by a far more discerning and fragmented investment landscape. Part 2. The US Market Deep Dive, a tug-of-war between value and growth. The Dow Jones Industrial Average provided the day's most prominent bullish story, reaching an intraday high of 45,203.52, its first record level since December 2024, before settling with a modest gain of 0.32%. This strength was not broad-based but was overwhelmingly driven by a single component: United Health Group, UNH. Shares of the health insurance giant soared by more than 11%, closing at 303.26 after a day of heavy trading volume. The catalyst for this explosive move was the disclosure that Warren Buffett's Berkshire Hathaway had initiated a new $1.57 billion investment in the company. In financial markets, such a move by the widely revered investor is interpreted as more than just a large transaction. It is a powerful signal of deep, long-term institutional confidence. The investment signifies a belief in United Health's durable business model, its capacity for resilient cash flow generation, and its defensive characteristics in a period of heightened economic uncertainty. This Buffett effect rippled through the healthcare sector, prompting a flight to quality as investors sought refuge in companies perceived as stable and insulated from the inflationary pressures plaguing other parts of the market. In stark contrast to the Dow, the technology-heavy Nasdaq Composite faltered, ending the day nearly flat after facing significant headwinds from both macroeconomic data and geopolitical rhetoric. This performance highlights the vulnerability of growth-oriented sectors to shifts in the economic outlook. The primary macro-level event influencing Friday's trading was the July Producer Price Index (PPI) report, released the prior day. The data revealed a month-over-month increase of 0.9%, a figure that dramatically exceeded the consensus forecast of 0.2% and marked the most significant monthly jump in over 3 years. On an annualized basis, producer inflation accelerated to 3.3%. 10. The PPI, which measures inflation at the wholesale level for goods and services, is often considered a leading indicator for the more widely watched Consumer Price Index (CPI). This unexpectedly high reading sent a shockwave through markets, reigniting fears of persistent entrenched inflation. It directly challenged the prevailing narrative that price pressures were steadily abating, forcing investors to reconsider the potential path of U.S. Federal Reserve monetary policy. The notion of imminent interest rate cuts was pushed further into the future, replaced by the specter of a higher-for-longer rate environment. The reaction in the bond market was swift and decisive. The yield on the benchmark 10-year U.S. Treasury note climbed to 4.29%. This is a critical development because the 10-year yield serves as a foundational risk-free rate for valuing other financial assets. As this rate rises, the present value of future earnings is discounted more heavily. This mathematical reality disproportionately impacts growth stocks, such as those that dominate the Nasdaq, as their valuations are heavily dependent on earnings projected far into the future. The surge in yields made these future profits less valuable today, triggering a rotation out of the technology sector. The broad anxiety over inflation and interest rates was compounded by specific acute pressures on the semiconductor industry. A direct catalyst emerged from President Donald Trump, who signaled that new tariffs on semiconductor chips could be implemented imminently, rattling investors and raising concerns about supply chain disruptions, increased input costs, and dampened global demand. This geopolitical threat created a perfect storm of negative sentiment, when combined with concerning news from within the sector itself. Applied Materials (AMAT), a key manufacturer of chip-making equipment, saw its stock plummet by 13.5% after it lowered its fourth-quarter financial forecast, citing a cautious outlook. The combination of a macro headwind, inflation, a geopolitical threat, tariffs, and a negative micro-level report, AMAT's guidance, proved toxic for the sector. The selling pressure was evident across major chip makers, with NVIDIA, NVDA, falling 1.19%, Broadcom, AVGO, slipping 3.14%, and Advanced Micro Devices, AMD, losing 2%. Part 3. The Global Economic Picture Contrasting Fortunes. The economic data and policy announcements from around the world on August 15th painted a picture of three major economic blocs on starkly different trajectories. While the US grappled with resurgent inflation, China contended with a structural slowdown, and India unveiled an ambitious, domestically focused growth agenda. This divergence underscores a global economy that is no longer moving in sync, creating both opportunities and risks for international investors. A raft of economic data released by China's National Bureau of Statistics for July 2025 pointed to a broad and deepening slowdown, raising significant concerns about the health of the world's second-largest economy. Industrial output, year-over-year growth in factory production slowed to 5.7%, a notable deceleration from the 6.8% pace in June and marking an 8-month low. This suggests that the manufacturing sector, a critical engine of China's economy, is losing momentum. Retail sales. Growth in retail sales, a key gauge of consumer health, rose by just 3.7%. This was the slowest rate of expansion in 7 months and a significant drop from June's 4.8% increase, indicating that domestic consumer demand remains stubbornly weak. Property market crisis. The prolonged downturn in the crucial real estate sector continued to worsen. Property investments plunged by 12% in the first 7 months of the year, while prices for newly built homes in major cities fell 1.1%. With a large portion of Chinese household wealth tied to property, this persistent crisis acts as a major drag on consumer confidence and spending. Fixed asset investment. Investment in infrastructure, equipment, and other fixed assets rose by a meager 1.6% in the January to July period, another sign of decelerating economic activity. The implications of this data are global, as the world's factory and a voracious consumer of raw materials and finished goods. A slowdown of this magnitude in China signals weaker global demand, posing a significant headwind for international companies and commodity exporting nations. Trading activity across European markets was largely subdued, with major indices like the German DAX and the Pan-Continental Stock 600 closing nearly flat. This quiet session was primarily due to August 15th being the Assumption Day, a public holiday observed in many key Eurozone nations, including France, Italy, Spain, Austria, Belgium, and parts of Germany. The holiday resulted in thin trading volumes and a lack of significant market-moving news from the continent. This lull occurred against a backdrop of an already fragile European economy, which recorded sluggish GDP growth of just 0.1% in the second quarter and continues to face challenges from stagnant consumer spending, making it particularly vulnerable to the economic headwinds emanating from China. While India's financial markets were closed in observance of the nation's 79th Independence Day, the day was marked by a major policy address from Prime Minister Narendra Modi that laid out a bold vision for the country's economic future. The centerpiece of the speech was the official launch of the Pradhan Mantri Viksit Bharat Rozgar Yojana, PMVBRY, a massive employment incentive scheme with a budget of nearly Rs 1 lakh crore, approximately $12 billion. The program is designed to stimulate formal job creation through a dual incentive structure. For employees, individuals securing their first job in the private sector with a monthly salary up to Rs 1 lakh are eligible to receive a direct financial incentive from the government of up to Rs $15,000. This payment is disbursed in 2 installments after 6 and 12 months of continuous employment, with the second installment contingent on completing a financial literacy module. For employers, companies registered with the Employees Provident Fund Organization (EPFO) will receive subsidies for each eligible new hire, directly reducing the cost of expanding their workforce. The government projects that this ambitious scheme will help generate approximately 3.5 crore new formal jobs over the next 2 years. Beyond this landmark scheme, the Prime Minister's address reinforced the broader themes of his economic agenda. He reiterated the goal of transforming India into a Viksit Bharat, developed India by 2047, driven by a powerful push for Atmanirbhar Bharat, self-reliant India. This strategy emphasizes building domestic capacity in strategic sectors like defense manufacturing, renewable energy, and semiconductors. Modi also announced plans for a next-generation GST reform to be implemented by Diwali, promising to simplify the tax system and reduce the tax burden on everyday items and for micro, small, and medium enterprises (MSMEs). Part 4: Crypto's Crossroads, a pullback, tempered by regulatory breakthrough. The digital asset market on August 15th perfectly encapsulated its dual identity. In the short term, it behaved like a high-risk technology asset, selling off sharply in response to macroeconomic fears. Yet on the very same day, a long-term, structurally bullish development emerged from a key US regulator, highlighting the market's ongoing maturation and integration into the mainstream financial system. The cryptocurrency market experienced a sharp and swift reversal from its recent euphoria. Just 24 hours after Bitcoin had surged to a new all-time high above $124,000, it underwent a significant correction, retreating to a price of around $119,186, a daily decline of 2.3%. Ethereum, the second largest cryptocurrency, followed a similar trajectory, falling from levels near $4,800 to settle around $4,640. This sell-off was not driven by crypto-specific news but was a direct consequence of the hotter-than-expected US Producer Price Index data. As a high beta risk asset, cryptocurrency prices fell in tandem with the Nasdaq as fears of a more aggressive Federal Reserve took hold. The downward momentum was dramatically amplified by a massive deleveraging event in the crypto derivatives market. In a 24-hour period, over $1 billion in leveraged long positions were forcefully liquidated, a cascade of selling that exacerbated the price decline. Amid the negative price action, a landmark announcement came from the US Federal Reserve that provided a powerful counter-narrative. The central bank announced it was officially sunsetting its Novel Activities Supervision Program. This specialized program, established in 2023, was created to apply a heightened level of scrutiny and oversight to banks engaging in activities related to cryptocurrency and financial technology. It required banks to navigate additional compliance hurdles and signaled a cautious, if not skeptical, stance from the regulator. In its official statement, the Fed explained that it was ending the program because the central bank has now strengthened its understanding of those activities, related risks, and bank risk management practices. As a result, the supervision of these activities will be integrated back into the standard normal supervisory process applied to all other banking operations. This move represents a profound and fundamentally bullish signal for the long-term adoption of digital assets. It effectively normalizes crypto within the traditional banking framework, moving it from a novel and exotic activity to one that can be managed through established risk protocols. The decision was immediately hailed by industry proponents. MicroStrategy Executive Chairman Michael Saylor, a prominent Bitcoin advocate, declared on social media that with this change, the road is now clear for Bitcoin and banking. The move is seen as removing a significant barrier to entry for large, regulated financial institutions to offer crypto custody, trading, and other services. The Federal Reserve's decision does not exist in a vacuum. It aligns with a broader, coordinated shift in the US regulatory posture towards digital assets. This includes the recently announced Project Crypto initiative from the Securities and Exchange Commission (SEC), led by Chairman Paul Atkins. This project aims to move away from a regulation by enforcement approach and toward establishing clear, bright-line rules to help market participants determine how different digital assets should be classified and regulated, with the stated goal of making the US a global hub for crypto innovation. Together, these moves signal a gradual but decisive pivot towards creating a workable and transparent regulatory framework for the industry in the United States. Part V: Synthesis and Forward Outlook. August 15, 2025 will be remembered not for a single unifying market theme, but for its powerful and conflicting cross-currents. It was a day that laid bare the complex, fragmented nature of the current global financial landscape. In the United States, markets were torn between a flight to the perceived safety of value stocks and a deep-seated fear of inflation's impact on growth assets. Globally, the world's major economies appeared to be decoupling, with China showing clear signs of a structural slowdown even as India confidently launched an ambitious plan to accelerate domestic growth and employment. Perhaps nowhere was this tension more evident than in the digital asset space. The crypto market demonstrated its dual nature, succumbing to a short-term, macro-driven correction on the very same day that it received one of its most significant long-term, structurally bullish regulatory breakthroughs. The key takeaway for investors is that the market is becoming increasingly nuanced. The simple risk-on, risk-off labels of the past are insufficient to capture a reality where different asset classes, sectors, and even individual companies are responding to different drivers simultaneously. This environment demands a sophisticated approach that looks beyond headlines to understand the deeper and often contradictory forces at play. Looking ahead, the market's focus will remain intensely fixed on several key areas. The immediate test will be the upcoming U.S. Consumer Price Index (CPI) report, which will be scrutinized to see if it confirms the inflationary signals sent by the Producer Price Index. Any further commentary from Federal Reserve officials regarding their policy path in light of this new data will be critical. In Asia, the world will be watching for a potential policy response from Beijing to its alarming economic figures, as any stimulus measures could have significant global repercussions. Finally, the financial industry will be closely monitoring the practical implications of the Federal Reserve's decision to normalize crypto supervision, watching for signs of increased engagement from traditional banking institutions. We hope this video was informative. If you think it did, then please do like and share the video. Also, do subscribe to our channel for such wonderful daily content. For more information or for your personal financial advice, kindly connect with us on the details given in description. I will see you in the next video. Thanks for watching.